Guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is time for us to talk a little bit about energy again. And in particular, this time, what we want to do is talk a little bit about a couple of energy stocks and maybe compare them one with the other. But particular, I want to draw your focus to the one in the center of the screen here, which is Devon Energy. And of course, if you had been paying attention to energy stocks last year, you would have known that we would have noticed that Devon was a high-flying stock for 2021. The question is, will they do it again in 2022? So I thought what we will do in this particular video is compare your favorite stock and mine, Oxy, to Marathon Oil, to Magnolia Oil and Gas, and to Chevron. Now, Chevron, of course, the old steady Eddie, almost a foundational stock. You guys know where I am in terms of Oxy. We've talked about it a lot. Marathon Oil, I think most of you will know. I'm not sure if many of you are familiar with Magnolia Oil and Gas, but I'll tell you sort of the background to this. So Sid from Japan sent me a note and he said, I've been watching your videos and I now have positions in Occidental and Devon. And then he says, I'm doing my homework, which is a good thing to do because the last thing you want to do is listen to me. But Sid says, I'm curious if Devon will continue the big run that it had last year. And then at the bottom here, he added a second comment and he said, it would be great if you can compare Devon to companies like Marathon and Magnolia. You know what? Let's take a quick dive into these and then we'll spend a few minutes just talking about Devon specifically, Devon Energy. But let's take a look at these five that I mentioned. So two of them are sort of the same, U.S. oil integrated. That's Occidental and Marathon. One of them is similar to the other in terms of Devon and Magnolia being oil exploration, U.S. exploration specifically and product. And then we have Chevron, which is obviously a super major, which is oil and international integrated. So two of them are the same, Oxy and Marathon. Two of them are the same, Devon and Magnolia. And one of them, the super major, is a little different because it's international integrated. But let's take a look here and see what's going on. So when we look at the stochastic just for to sort of jog your memories a little bit, a low reading below 20, which doesn't apply in this particular instance because they're all high. High readings on the stochastic score, which is above 80, indicate that the price is near its high for the given time period. So a high stochastic is above 80, and we can see in the order that I have them here, which is going to be the same all the way through, Oxy at 86, Marathon at 82, Devon at 76, and Magnolia at 73, and Chevron at 67. So high ratings, so we have 2-year, Oxy and Marathon, are above 80, indicates the price is high, near as high for the given time period, which of course is true because both of them are trading sort of at or around its high. Devon is very similar, and two of them are falling a little short. How about alpha? The positive alpha shows us that the stock produced a greater return than the benchmark. So in this particular instance, we have two of them, Devon, bookending with Chevron, the other three. Devon, the highest positive alpha by far, 185, and Chevron sort of the laggard at around 50, and the others somewhat in between. So, you know, make of this what you wish. These are the technicals. So if you're a technical guy and you focus specifically on stochastic scores or weighted alpha, that's probably what you want to look at. The rest of us will look at that and maybe look at some of the other things. How about the performance? So I'm not going to spend too much time or any time really talking about 5 days or 1 month. But if we look over a 3 to 6 month period, we can see Oxy sort of 11 and 40% respectively, 20 and 70% for Marathon, 27 and 100, near 100% for Devon Energy. Magnolia, the underperformer year on a 3-month basis, but not too bad, 52% on a 6-month basis. So if you had a position in Magnolia, you probably are quite happy with where you're at. And then Chevron has been kind of doing okay. If we look at the key statistics for the individual stocks in a year, I'm not going to dwell on it either. The only thing I want to point out here is that beta, the 60-month beta. So here we're looking at a 5-year period on beta. And what is beta? It's the measure compared to, in this case, the S&P 500, which has a beta of 1. In other words, that's the index measure or benchmark. So any stock that swings more than the market over time has a beta above 1. And you can see they are all above 1. Chevron kind of doesn't deviate too much from the market, 1.28 over a period of 5 years compared to the S&P 500. So pretty much there or thereabout. If you're invested in Chevron, you probably are just using it as a foundational stock and collecting dividends. If you're looking for growth, you'd be looking at one of the other 4. We can see Magnolia and Oxy are sort of the same, and both Marathon and Devon 3 times more deviation from the market than the norm or the benchmark. The PE or price to earnings ratio, and for those of you who don't remember what that is, the price to earnings ratio is basically just the mathematical equation of the price of the stock divided by its earnings. And what it's showing you is that if the PE is high, the stock is probably overvalued, or otherwise investors are expecting high growth. Now, these two things are sort of almost contradictory one to the other. On one hand, you can say the stock is overvalued if the PE is too high. And look at Occidental, the PE is already at 143. So at a glance, you could say the PE is way too high, or otherwise investors are expecting high growth. Well, I would fall into the latter camp on that one because I am still expecting high growth from Oxy, even though it's in the sort of $38 range. It could be very volatile. It can go up and down over the next 3 to 5 years or so. I would expect Oxy to be doing much better from a stock price point of view than where it is currently, especially if they get their debt down to 25 billion and manage to achieve institutional grade, in terms of its investment rating. And at the same time, perhaps start rewarding the shareholders who have been patient with them. However, the other 3 in a row here, Marathon, Devon, and Magnolia, have PE ratios that are actually quite interesting. If it's sort of in the 20s for energy right now, it's actually probably arguably a little bit undervalued. But before you get too happy on those 2, look at Magnolia. Its PE is only 12, which means Magnolia is actually quite cheap. So I don't know Magnolia very well. I haven't studied it at all. So you guys can let me know sort of what you think on these 5 that I'm sharing with you right now. How have they done over the last 6 months? So the outperformer here is Devon, as we talked about a minute ago, and the underperformer, if you have picked up 32% over the last 6 months, you're probably not too unhappy with that, in addition to the nice dividend that Chevron pays. But on the graph here, you can see that Devon was by far the outperformer. Marathon had a very good year as well, and especially over the last 6 months. Not too bad. When you look at Magnolia and Oxy, 55, 43%, and then even Chevron at the back end of it, as I said, 32% over 6 months. Not too bad. How about over 1 year? Well, Chevron is the underperformer over 1 year, but it still came in at plus 50, which is not too bad. Oxy plus 81%, but look at the outperformance of these 3. Magnolia 144 and Marathon 168 and Devon 203% over a 1 year period. Well done to the guys who were long on Devon. The motherhood question is, can Devon do it again in 2022? And Mr. Oxy thinks probably not. In other words, I think Devon will be a good performer along with the rest of the energy stocks, but I think Devon has been rewarded for things that it had done well, and we're going to take a look at that one right now, just in a deeper dive, just on Devon Energy Corp on its own, instead of comparing it to the other 4. So a couple of things to note here. Firstly, it's trading at its 52-week high or thereabouts, $51 currently, and 52-week high is 54. We'll see where it's going in just a minute, but remember the price of around $50, $54, because I'm going to come back to tip ranks in just a minute, and we'll compare and see how that prediction goes. Market cap $35 billion. It's not a small company by any means. We talked about the PE ratio of in the sort of mid-20s to 30. Interesting at the current PE, potentially even a buy. You can see that the institutional investors have climbed into Devon Energy in a big way, 86% owned by institutions, which means the big party is probably over. But who knows? You can never predict where the stock price is going. But let's take a look at the performance just here for a second. So over the past 1 year period, here's the significant difference between Devon, for instance, and a couple of indices I'm comparing it to. So these thin lines here at the bottom, respectively, are the purple one, which is the S&P 500. The pink one is the Dow Jones Industrial Average. And the black one, with bouncing up and down, is the NASDAQ. Now, depending on how you measure Devon against the indices that I'm showing you, what's noticeable here at a glance over the past 1 year is that when the market, especially the NASDAQ, which is tech heavy, took a huge dive in 2020, and then again, that was in March, April, and then again in May. And then it was sort of steady for the most part until it took a very recent dive as well. Of course, the NASDAQ is the tech-heavy index. So tech, if you really think about it, and if you follow people like Kathy Woods and ARK in terms of her investment portfolio, you'll know why it's down such a lot, because it dived on 3 significant occasions, while the rest of the market over this period was pretty much just trending flat, slightly up. And that's what saved Devon. Devon is the fat black line here at the top. It never took a dive. And if you don't dive when the market goes down and you kind of hold your position, which Devon did, then when the market bounces back up again, you maintain. And then the market dives again, but you maintain. You kind of edge up. You edge up all the time. And that's how you end up at 200% above the benchmarks. Let's take a look at Devon's profitability analysis. Pretty good, so I look at the gross profit margin here. TTM is trailing 12 months, 42% against the industry's 35%, so sort of there or thereabouts. In other words, it's a match, but Devon comfortably outperforms the industry or its peers when it comes to operating margin, as well as on net profit margin. This net profit margin is actually very impressive, 14% compared to the industry's negative 2%. So that's an interesting one, but I do feel that Devon has already been rewarded for that in the past year and a bit. How about the growth rate? So this is a little different here. We're looking at the earnings per share growth on a most recent quarter basis. It's pretty good, but look at the bottom here. So if you look at revenue growth over the most recent quarter, it's sort of in line with its peers. But if you look at revenue growth for a trailing 12-month period, it outperforms. So that's one of the reasons why I say Devon has been rewarded handsomely for its revenue growth on a trailing 12-month basis, because it outperformed its peers significantly. But on a most recent quarter basis, that sort of gap between Devon's revenue growth compared to its peers has been shrinking. So when you look at it over a trailing 12-month period, it was a big gap, but on a most recent quarter basis, it's more or less in line with its peers. So it's kind of no longer the outperformer, but they have done some phenomenally good things. One of them has been their management of their debt. Even though Devon's debt to capital ratio is in line with the peers again, so 42% versus the industry's 35%, the change in debt quarter over quarter has been where Devon has done really, really well, reducing their debt. A quick ratio is nothing to speak of. So just to kind of just serve your memory again, or jolt your memory a little bit, the current ratio are all the current assets and liabilities compared to all the current assets. So all the current assets compared to all the current liabilities. The quick ratio is cash compared to bills that are due within the next 30 days or so. So the quick and current ratio are not necessarily the same. Devon doesn't have a rating there because they don't really have a current ratio that's favorable right now. But how this is as of the last quarter. But then in the most recent quarter, interest coverage, it's 11.63 times their interest coverage repayment that is required. So Devon is in a very good position to be serving their debt right now. So debt is a non-issue. Great job, Devon. But I think, as I said a couple of times now, Devon's already been rewarded for that. So if you think Devon's going to fly again and take off, please let me know if you think so, firstly, and secondly, maybe why. The other reason why Devon was rewarded so handsomely is because right at the bottom of the screen, you look at their liabilities over the last 5 years, how they've decreased it down to $7 billion, where it is right now. So they've done a great job, and the market has handsomely rewarded them for that great job. I am not confident that they are going to achieve the same kind of return for investors in 2022 as they had done in 2021 and 2020. The analyst target, remember I said earlier, keep in mind the Devon price currently at around $51.50 and the most recent 52-week high, $54, while the upside is only 8%. So if you look at the 19 ratings, which quite a lot of analysts are covering them, 15 say buy, 4 say hold, and the highest price target is 65, which would be a nice tick upwards. The lowest price target 48, which is down about 10% from where it is currently. 55 is a much more reasonable price target from where it is currently at around $51 compared with the type of movement we saw in Devon last year. It's an outperform 8 out of 10. Analysts rated a strong buy. I just talked about the price target. Most of the sentiment on Devon is positive. I am positive on Devon too. I do not have a position in Devon, but I think maybe there's going to be a more market-related performance from Devon for 2022 than what we saw in the previous sort of year or 18 months or so. Guys, so let me know what you think. If you have a position in Devon, tell me what you're thinking. Are you buying or buying some more, adding to your position, or are you selling, taking some profit, or are you just holding and seeing where it goes? And if you think it compares favorably or not to the other 4, let me know as well. I look forward to your comments. And of course, if you like my content, please take time to hit the subscribe button so that we can make sure we build a good community of like-minded investors and make sure that we help each other to achieve some wealth over time, right? Patiently, but let's do this. Let's do it together. On that note, this is Mr. Roxy signing off, saying thanks for watching. Bye-bye.